Almost every other day, I got this message from traders that what do you mean by the ATR? What do you mean by the moving averages? The way you use Fibonacci retracement, how does it actually work? And what settings do you use for all these indicators? Now, I have been using these indicators from so many years in almost every single strategy. I use this indicator as an added confluence. Now, if you follow me from a couple of years, then you have heard me talking about these indicators a lot. And if you have any confusions, how I use them, what factors I look at when I use the ATR indicator, which is average to range, why I use them, the moving averages, and then we have the Fibonacci retracement, how I use the Fibonacci retracement. So that is what I'm going to explain you in the first part of the video. And the first part of the video is for every single one of you. Follow me on my YouTube channel, who listen to my analysis every single day, because if you understand how I use them properly, then my analysis will make a lot more sense to you. Because in this video, I'm going to clear all the doubts you might have. I'm going to go through some basics of these indicators, how to use them, and what these indicators does in the market if used correctly. I'm going to make a separate detailed video of these three indicators where I will show you how to implement this indicator with the strategies, with the exact rules, and I'm also going to make a detailed video where I'm going to show you how to mark the support and resistance and how you will identify if the support is going to be broken or if the price is going to hold on with the support area. Something to make in next couple of weeks. In this video, I'm going to talk about these indicators, and trust me guys, it's going to help you a lot in your trading if you listen to the first part of the video. But if you are someone who just want to listen to the analysis part of the video, you can always skip it to the timestamp you have already seen at the start of this video. I'll see you guys right after the intro. Right, so let's talk about the ATR indicator. Now, why I use the ATR indicator? And I use that indicator heavily, and this indicator has been used by the traders out there a lot to calculate the targets. And why and what is the ATR indicator? Now, ATR is the indicator which you can plot on your charts if you are trading on MT4, if you are trading on TradingView platform, wherever your broker should have these indicators on the platform. If not, then you need to change the broker, because this is something you need to have on your charts, and this is something that should be on your broker's platform. Now, here on TradingView platform, you can always go on the indicator section and just type average true range right here. So you click on it, then you will have the indicator on your charts right there. So initially what you will get it at the bottom of the chart right here, and you can always push it towards the top of the chart like this. So like that, you can have it on the top of the charts and you can squeeze it according to your own likings. Now I have this indicator set, and if you go look at the settings right here, always 14, and just leave the settings as it is. Now the length is 14. So what it does, it actually calculates the last 14 candles from high to low, and then it gives you the number which you see right here on the top left corner, and then it comes up with the number after it calculates the last 14 candle. Basically, it calculates the movement of the last 14 candles, and then it comes up with the number which we call the ATR. Now, here on the Forex, the way we use ATR indicator, once you plot this indicator, you always look for the first two numbers after the decimal. So in this example, you see 25. That is what we have the ATR right here. If you hover over this candle, it comes up as 23. So that means ATR of the current candle is 23. Now we always discount the last number, which is after 23. And why is that? Because that number is used by the future traders or for the Forex traders who are really precise with the stops and targets. So we can discount the last number, and we always look at the first two numbers after the decimal. That depends on the time frame. So on 4-hour time frame, the ATR is coming up as 23. Now if you move back on a daily time frame, what is the ATR is coming up? It's coming up as 70 pips. So these are the basics you need to look when you're plotting your ATR indicator. Like I said, I'm going to make a full video of how you read the ATRs for the different pairs and how you can use them if you implement these in your strategies. Now, I want to show you the importance of the ATR. Now you understand what ATR is. It keeps you with the volatility of the market. Now if you don't use the ATR with the stops and target, let's say you are a beginner and you have no idea about trading and you're just starting out in Forex and you just start placing your trade with the tighter stops and target. And what happens is, now here let's see, I have this pair. I want to show you something here. If you see this market, it's not trending. It is just ranging sideways. We do not have a trending market here. But once the condition meets, we try to take the entries. Now, how we take entries? I know that the market is not trending, so I'll try to stick with fixed target rather than managing my trade. If the price is trending nicely, if you see a nice uptrend, if I would have got a position somewhere here above 50 EMA, in that case I'll manage my position because I know that price is pushing up in a trend, and like that I can optimize my target and I can keep on getting better reward to risk ratio. But in this type of market, the way we use the ATR, exactly what I'm going to show you right now. So this is a pair I trade a lot because one of my favorite pair to trade, one of my strategies right here, as you can see. And right here we have an entry of bullish engulfing pattern. Let me zoom that up for you. So now we are above 50 EMA. We have a bullish engulfing candle. We are ready to enter this trade. Now let's go back in a replay mode so that it will make more sense to you. Right here. So we are here. We had a nice entry. And now I'm ready to take my trade, set up my target. And now let's imagine I'm just a beginner. I have no idea about Forex. If you hover over this candle, if you look up, the ATR is coming up as 23. Now if you go less than an ATR, then it's a very likely chance that the price will hit your stop loss and can push back up towards your target. Now you can add some numbers, or what you can do, you can pull up your stop loss to the wick of the swing low candle before the entry candle, which is right here, and then add 1 ATR. The target till the wick is 9. If you add 23 with 9, the number comes up is 32 pips. So 32 pips will be your stop loss. So this is how you set up your correct stops and target. And if you go 1-to-1 right here, now if I'm a beginner, what I would do, I would try to keep my stop loss very tight, and you have gone 1.6 to 1 risk to reward ratio. Let's say you have gone 1.4 to 1 risk to reward ratio, something like this. So if you have set your targets like this, not according to the ATR, what happens is we play the market and it quickly hit your stop loss, and what happened after that? It pushes back up. How frustrating would be this? Now, if you remember the way I have shown you to set your targets according to the ATR, which is right here, set your positions. What is the ATR of the candle right here? Is 24. And if you move your stop loss to the swing low and then add 1 ATR with 9, which is the number here, and that comes up with 33 pips. So 33 pips will be something like this, and then that hit your take profit. Now if you want to go 1.2 to 1, you can also manage it 1.2 to 1, you can go 1.3 to 1. That's totally up to you. So that is the benefit of aligning yourself with the volatility of the market. Not just keeping a tighter stop loss will give you lots of money. It's not like that. You need to understand the volume in the market to set your stops and targets. So a very good example here. I want to show you one more example very quickly. Right here, the next example we have for a bearish trade. Exactly after a couple of days, we have this condition. Now I'm going to take you back in a replay mode, which is, now what do we have? We have a price trading below 50 EMA. We have broke below 50 EMA. Now all we need to look is for bearish pullback trades. So at this point, how do we enter the trade? We place our position right at the close somewhere here. And what is the ATR? ATR is 23. So what is the rule? Always add at least 1 ATR or add some numbers with the ATR. You always need to be above the volatility of the market. It always should be above what you see the number here if you are trading Forex, and then you test the best performing pairs and then you test how it's working with your strategy. But let's add some number with the ATRs. So in this case, the ATR of this candle is 23. So we know that we're going to go at least above the wick, and that is more than the ATR. If you see the number is 38 pips above the wick. So we are aligned with the volatility. We are aligned with the ATR. So let's go 1-to-1. The reason I'm going 1-to-1 because it's not a trending market. So let's do 28, 38 right here. So let's move forward. The very next candle hit the ATR. Now something I want to show you here. Now let's say you are not aligned with your stops and target, and let's say you want to go with the bigger positions. You want to go 1.5 to 1, let's say 1.4 to 1, and you just want to be greedy here. Now the reason I say with the price is consolidating, that's why I'm not managing it this way. That is the reason I take a fixed target and don't get greedy here. Either you push your stop loss to break even so that if the price pushes back up, at least you are not out in a loss. You're out at break even. Let's say you're a beginner and you are just new to the trading. Now you want to move your take profit further down. So in that case, what happens is if you play the market, price pushes up and pushes massively up, and the results is hitting your stop loss, even though that would have been your nice winning trade aligned with the ATR, and we don't have to be greedy in this type of situations because the price is not trending. Either you go out at the break even, or if you see a nice trending market, something like this, if you entered your trade here, then why not manage your trade nicely, because price, as you can see, is trending nicely upwards, broken above the support area as well, and we had a nice bullish engulfing pattern. Let me show you that as well right here. Nice bullish engulfer, and in that case you can manage your trades unless you see a nice trending market. As you can see, it is not a trending market from quite a while now, but if you go back and see something like this, a nice trend from a very long time, something like this, if you see here a nice downtrend, and then if you decide to enter somewhere here with the bearish engulfer, in that case why not manage this trade, because you go back and see, yeah, it is nice trend lower. You can try to extract as much as profit as possible by managing your trade. So that is what I wanted to show you, how you can manage it and when not to manage it, and use the ATR for the stops and targets. So I hope that's clear now, and I hope you can able to set your stops and target with the exact rules. Now the next one, we have moving averages. Why moving average is important? It is important because the first thing I need to tell you what the moving average means. Moving average, if you click on it, it has different type of lengths. You can go 20 moving average, you can go 50 moving average, and or you can go 200 moving average. And these three moving average I use heavily for my analysis. I know that you have not seen me using 200 moving average. That is something I use for stocks and the other market as well. And that is what I'm going to talk about in the video, which I'm going to upload in next couple of weeks. So let's stick with two moving average, which is 20 and 50. Now the 20 is the faster moving average, and what it does, it calculates the close of last 20 candles, right? And every candle has a number which you don't need to know. It divides that number of last 20 candles with 20, and that is how it comes up on your charts, the 20 and 50 moving average. After dividing the number, it creates a trend which we call a moving average, that how the price is moving with the average number, and we use this indicator to identify the trend, if the trend is upwards or if the trend is downwards. And that is how we use in confluence with our strategy. Now, why moving average is important? Now, if you are a trend follower, you need to have a moving average. If you are a day trader or if you are a fast trader, you need to look for 20 period moving average. If you are a medium term trader, let's say you are a swing trader, then we use 50 period moving average. If you're a long term trader, of course we use 200 moving average, which I'm going to talk about in my upcoming video. So that is how we identify the trend. Now if the price is above the both moving average, mean the trend, and we have a good gap between the both moving average, mean the trend is very strong. As you can see, this pair has a very strong uptrend. Now if you look back here, we have a gap in between both moving average, mean the trend is very strong towards the downside. So that is the advantage of the moving average. Now you can implement your own strategy with this moving average. You can either enter your trades when the price is above the EMAs, and if the price hit the EMA with some sort of signal, which is a 382 candle right here, then you can enter your trade. Set your stop loss below the moving average. So this is a strategy you need to backtest, implement in your trading, and that is something you can use for added confidence. You can use 50 period moving average. If the price breaks below 20 EMA, then you can use 50 period moving average for extra confidence. You can have some signal like bullish engulfing pattern as an added confidence. Price is trading above 50 EMA. In a nice trend, we have a price hit 50 EMA followed by bullish engulfing pattern, and that is your entry. Take your entries something like this. So these are the confluence you need to look for when you are making your own rules. Rules are very important. Without rules, you are just gambling in the market. You say the price is now below 50 EMA, let's start selling. No, all you need to see some sort of signal when it's trading below 50 EMA. Signal something like bearish engulfer right here. So you have a confirmation of the trend is trading below 50 EMA. We had a cross as well. That is a strategy I've already uploaded. If you want to check that out, it's in my playlist. So that is how you do your analysis with some rules. So these are the basic rules you need to understand when you are taking your trades. The moving average is important to identify the trend, and then when not to use moving average. Every trend must end. And where does it end? It ends at the area of value right here, which is the support and resistance area. Now in that case, the price is trading above nicely, hit the major area, form a nice bearish engulfing candle. Right here we have a signal that we have a sellers now in control, telling us now your trend is over, I'm gonna push you down, and we're gonna have a nice downtrend from here, and then we have a change in the trend. And that is something I will explain you in my upcoming videos, how to understand and how to identify when the price hit the area of value, and how you can tell if it's going to be broken above or if the price will likely reverse. This is something you need to wait for my upcoming video. So that is how you need to identify this area of value when the trend is over. So I hope it gives you a little insight of the moving average and the ATR indicator. Now let's move on to the Fibonacci retracement. Now Fibonacci retracement has been used by the traders out there a lot to calculate the swing highs, swing lows, to optimize their targets, to set up the entry points, and a lot more they can do with the Fibonacci retracement if you know how to use them. Now I'm going to give you the basic rules of using the Fibonacci retracement when you are entering your trade, and how you can optimize your targets using the Fibonacci retracement. Now the first thing you need to see, you have a Fibonacci retracement, and right here we have a Fibonacci retracement. So all you need to have on your charts is 382, 0.5, which is 50% retracement, 786, 1.618 retracement, 25% retracement that we use sometime. So these are the only settings you need to have on your charts. Keep it simple, because if your charts look simple, then the trading become simpler as well. So all we need is these settings. Now, if you have seen me trading net gas from last 2 trades, I have taken my target using my Fibonacci retracement. Now, how I use Fibonacci retracement to calculate my target. Now, this is a good example of the trade I took. Now, the 2 ways you can enter this trade. Let's go back in a replay mode right here. Now we had a price broke above, pulled back, form a nice bullish engulfing pattern. In that case, either you can enter your trades at the close of this candle, right? So in that case, how we can enter this trade at the close and go below the wick, and then even if you go 1-to-1 risk to reward ratio, that looks something like this. Here comes the Fibonacci retracement and how we can optimize the target. Now with the Fibonacci tool, the benefit of that is you can get a better reward to risk ratio. Now from the low of this candle to the high of this candle. So the 2 ways of entering this trade is one way, as we have a good bullish candle right here, a big momentum candle, and if you see the candle is almost of 65 pips, so it's already a lots of volume in the market, and sometimes I do not want to enter my trade right at the close if the candle is that big. What I do with my Fibonacci tool, I either enter at 50% retracement or I either enter at 786 retracement. So these are the 2 places I would like to enter my trade with a pullback. And the drawback is that sometime you miss the opportunity. Let's say if the price just pushes from here, hit your take profit. In that case, you'll miss out in the trade. But if it pulls back, what happens is you will get a good risk to reward ratio. Now, let me show you how it works. So at this point, where is the 50% retracement? Right here. So I would like to enter my trade at the 50% retracement. That is how exactly I've entered my trade in net gas, which I'm going to talk about in the analysis part. My target is not hit yet, not yet, but it hit my target right at this candle. Now the benefit of that is my entry is now at the 50% retracement. Now if you see a nice risk to reward of 1.721 risk to reward ratio, stop loss can be remain the same, 68 pips, and the take profit can be 119 pips. So that is how you optimize your targets. Now if you decide to enter at 786 retracement, you can have a better reward to risk ratio, but in this case you would have missed out in this trade because the price just did not hit the 786 retracement. Now let's keep at 50% retracement. Let's keep your entry at 50% retracement, something like this. Now I've entered my trade here, and now let's see how the price goes. See, it did not hit 786 retracement, but it then pushes up, shoots up nicely. So that is how you play around with the Fibonacci retracement, and that is exactly how we use in our net gas trading. From the last 2 trades, we got a nice trade using Fibonacci retracement. Now, if you have seen the first part of the video, you will understand how we use Fibonacci tool if you want to optimize our stops and target. Now, if you would have entered here, that would be also a take profit hit, but then you will have to see these big 4-hour candles, red candles, and that might be some stress for you and you might get panic and come out of the trade. But if you are a beginner only, but if you are a professional trader, let's say if I would have entered here, I'll still wait. Once my buy button is clicked, sell button is clicked, I only exit my trade if my stop loss is hit or if my take profit is hit. So that's all I want to talk about in the first part of the video. I hope that make sense to you. I'm going to make a complete video on how you take your entries with Fibonacci candle, with 382 candles, and how you can take your entries in the zones and the benefits of the ATR, benefits of the moving average. All that is coming up very soon in next couple of weeks. So hang in there, subscribe so that you won't miss a daily updates and educational content like this every other week. So if you have made it to the first part, you need to pause the video here and click a like button for me. Done? Awesome. So let's move ahead and move to the next part of the video, which is our analysis. And the analysis starts from natural gas. I'm going to go for gold, silver, and crude oil as well. So what do we have right here? So as you can see, we had two similar entries in last month. One is right here with the Fibonacci retracement, and one is right here, which is a recent one we had on Friday. So let's see how we took this entry so that you understand how we entered this trade and why I use the Fibonacci retracement, why I did not enter at the close. And let's see this one as well, the similar conditions, so that you also understand the condition and how to optimize your targets without trading blindly. Looking at this good bullish candle, it is already a momentum candle, so I won't be entering at the close of this candle. So the way I would enter this trade, if you want to, from the wick till the wick right up there. Now at this point, if you want to enter this trade, the 50% retracement can be your entry right here, and targets can be 1 ATR only. 1 ATR is enough to hit my targets. So exactly the same as this condition, we can still go use Fibonacci tool from the low of this candle till the high. Let this candle close first, then use the Fibonacci tool again. Now once this candle is closed, exactly from the low to high of this candle, the entry can be right here at the 50% of this candle. So once we add a pullback of 50%, we have a limit order right here, buy limit order, and then we can go 1 ATR for a target. Not a very big target, only 1 ATR for the initial target. Then if you want to manage it, you can manage it further 1 ATR or wherever you want to take it. If the price break and close above 50 EMA, then we have a very good chance that price will keep on pushing higher till we hit the termination zone. Awesome. So how nicely the price reacted at this trade, and then recently we had a nice take profit hit on this trade. Now I want to show you how I've entered. Now it will make a total sense to you if you have seen the first part of the video. It will make the complete sense to you. You understand how we optimize a target with the Fibonacci retracement, and it will also make sense to you that when the price is choppy like natural gas, how we take some chunks of trade out of this choppy market when the price is not trending. You have seen the first part of the video. I've shown you how we have entered the trade with the ATR and how we managed to pull out some profits out of the market when we have this kind of price action. We still made some money, but exactly with rules. So right here, I've said that I'm going to enter my trade at 50% retracement, and I want to show you closely at this candle. Right here, we have a big green engulfing candle. Right here, I've mentioned that we're going to enter our trade if we have this candle. We had this candle, we had the condition met. Now I wanted to enter with a better target. So from the low of this candle right here till the high of this candle right here. Now let me zoom that up for you. Right here, right at the next candle, it triggered my order right with this wick at 50% retracement. Now the benefit of that is I get a better risk to reward ratio, which is 2-to-1 risk to reward ratio, as you can see. Now if I would have entered at the close, in that case the initial target would look something like this at the close of this candle, and ATR is 4. If you've seen the first part of the video, again you know how, and 4 is something like this. The initial targets would look something like this, but now we chose to enter at 50% retracement. So how nicely you optimized your target with the Fibonacci retracement. Now I will not do this every single time. I only do this if the candle is that big. If we have a momentum candle, something like this. If this candle closed something here, then in that case I would have entered right at the close of this candle with the market order. So that is why I use the Fibonacci retracement, in case you are wondering why we did not enter right at the close. So this is the reason. We had two big momentum candle because price already had a big amount of volume, and I don't want to just enter straight away. We can expect likely pullback when we have this type of big momentum candle. Better to enter at the 50% retracement or 786 retracement, which I've shown in the first part of the video. Now I know lots of you are confused with this bearish engulfing candle right here, and you're confused with your own platform data, which is a bullish engulfing pattern. I know that, but let me clear your confusions. The first thing, this bullish engulfing pattern is an invalid entry pattern. Now, I'm not sure about your strategies. I'm not sure how you trade, how you use your strategy, but according to my rules, according to my strategy, it is not a valid condition to enter my trade. Now, I can't explain this in a single video, but if you are my student in MMTA, you know all the 6 rules of entering this trade, and one of the rule is invalid. So that is why I'm not really concerned about this bullish engulfer, but I'm still looking at this bearish engulfing pattern right here, which is absolutely valid condition for my sell trades. So no ifs and buts. I'm not going to look at a bullish trade for looking at this candle, but instead I'll look at my bearish trade because we had a bearish engulfing candle that happened at 50 EMA, closed back below 50 EMA. So we had a nice trade with condition of buy, and I'm out of this trade, and I was looking for the next opportunity, which I've mentioned in my last video, that if we have a break above 50 EMA with 2 green candles, if you remember my last video said that, then we look for the pullback, and then we look for a good bullish engulfer, and that did not happen, but instead we have a nice bearish condition, which is one of the entry condition. Now we do not have much volume in the market. Looking at the ATR, it's only 3.8 coming up. If you see my first part, you know that how we calculate the ATR. So if you remove these targets for now, this is one of my pullback entry conditions. Now, like I said, it is a choppy market. I won't be managing any trades. I will just take a little scalp out of the market, pull out some profit, and then exit my trade. So now at this point, as you can see, the price is already pushed up. Now we had a better entry condition, and the entry will be at the close of this candle right here. ATR is 3.8, so we can either go 3.8, which is right here, something like this, your first initial targets, or you can add maybe some numbers with ATR. Let's say add 2 with the ATR. Let's go 5.8, something like this, just to have some extra room, something like this, and keep it above the wick right here if you want to look for the extra protection of this wick right here. Or if you want to just keep it a little bit below the wick, you can also go 4.9. So that is how you can optimize your target, not using Fibonacci, not required at this stage. So that is how your targets will look like. Now it won't be a bigger targets here. It can just be a pullback of 1 ATR, which is the initial targets right here. It can just be a pullback, hit a take profit, and then it can shoot back up again. So that is a little scalp we got, and then that is one condition we can expect. Or what we can get another retest of this zone here right here. Just let's make it more clear, and let's do it like this. So we can get a retest of this zone here, a hit of this zone, and get a possible bounce again. So that is what I'm expecting from NetGas. Simple and easy, not complicating things. So all we need to see, I'm looking for a nice pullback here, a nice fall, looking at this bearish engulfing pattern. If we can get a push down, hit of this zone, or hit of 1 ATR, and then a possible continuation towards the upside. We are still not bearish, but we can expect a pullback, looking at this bearish pressure, looking at the bears are taking over the buyers with this engulfing pattern, and we can get a pullback, and then we can get a possible push back up. Now for the trend continuation, which is the bearish continuation, I want to see a complete break and close below these lows. Once that happens, only then I'll look for my bearish continuations trade. Otherwise, I'm still going to look for uptrend. Price is still ranging in an uptrend, not breaking and closing below this area. That is why I'll still look for a little scalp, the way we've been doing from last couple of weeks, and that is what I'm expecting now from this red candle. So keep an eye here, look for the condition. The next buy trade will be from this rejection box, or if we have a push up, let's say the price opens up in gap above 50 EMA with good momentum, in that case I'll start to look for my buy trades only with the pullback. So these are the conditions I'll be looking at: buy above 50 EMA with good momentum if we open up a win gap, or if the price pushes up, or if we hit this zone here, and then with the conditions like 382 candle, pin bars, or my bullish engulfing pattern. All these conditions I'll look for to enter my trade. So I'm only looking for bearish pullback, a little pullback from here, that is enough to hit your target, and then price can likely push up from here. So that is what I'm looking at for net gas. Keep an eye here, look for conditions. Any confusions, you can always DM me on Instagram. Links are in the description. Next one, we have gold. Right here, gold is pushing lower. Now I've mentioned already that the price is pushing lower. We had this bearish pressure. It is not one of my valid pullback condition, but we had a nice bearish engulfing pattern right here, a valid condition. And if you see, let's say you have entered here with the ATR is 4.9, I'm now expecting a price to push at least 4.9 from here, which is around this recent lows right here. It can still push down. If you have entered here, $5 scalp will be your targets, and then you can manage it further 1 ATR and till the zone below, which is right here in green, 1907.11, that goes down to 1889.18. I know that's a big zone, but if I see a condition after hitting of this zone like a bullish engulfers, a double bottom condition, I'll enter my trade. Doesn't matter it happens at the upper level or if it happens in between or at the lower level of this area. Previously we had a condition at the lower level. All we want to see a condition when we hit the zone here in green. Once we have that, we are good to go. Long for now, I'm just looking for sell trades, looking at this bearish condition, this 382 candle. We have a good selling pressure and price can likely head lower. Next one, we have silver. It's pushing lower nicely, and as you can see, the price already tested 50% retracement, pushing lower. I'm now expecting a price to head lower and hit the zone, which is 22.57, that goes down to 22.02. From where we're going to look for buy conditions like bullish engulfers, double bottom, 382 candle, pin bars, whatever you want to call it. So I'm now just looking for sell trades, not looking for buy condition unless we hit the zone below right here, or we have a dramatic push up, break above 50 EMA, which is less likely. So keep looking for sell trade. I'm looking for a price to head lower, looking at this nice 382 candle as well. 50% retracement has been done, and now I'm expecting a price to head lower, hit at least 1.618 retracement. Before I move ahead, please do not take my words for your trading. This is just my opinion about the market, and this is how I take my trades. This is just something I use for my own analysis, and this is what I'm just sharing with you guys. If you like it, enjoy. If not, then it's still cool. So let's move ahead. Let's check crude oil. Now, as price is pushing higher, if you remember, I've said that we had a condition here and that did not play out, but I've also said that we can get a possible bullish engulfer above 20 EMA. That exactly has happened and that has played out. And let's see what I've said in my last video so that you can also understand conditions. We already have this bullish engulfing pattern that is also a valid condition, and price can likely head higher. For now, we can hit 20 EMA followed by bullish engulfer. Bullish condition, exactly something like this. If we have that, we are good to go long. Nice one. So we had this bullish engulfer. The ATR was 6.9 and price has pushed up nicely around $1. That's enough to hit your target. If you would have entered here, that would be a stop loss, but then we have an entry here, that would be a take profit, hit nicely. Now at this point, the next buy trade will be once we have a new high above this previous high. Once we have that, I'll look for another pullback, keep on taking longs until the price hit the zone above, which is right here in blue. Once the price hit the zone, we're going to enter sell trades with bearish engulfers, double top, 382 candles, inverted hammer, whatever you want to call it. Now, I also want to give you a heads up here, price can give you a big pullback, which is possible, and that big pullback can be 50 EMA. Once the price hit 50 EMA, we can get a possible bullish engulfing pattern, and then the price can head higher, and then we can look for condition at 50 EMA. Now we can also get a big pullback to the zone that has been recently broken by the price, which is 84.05, that goes down to 82.10. Now don't get confused here. All I want you guys to look for conditions. If you have a break above this high with the pullback, bullish engulfer, the bullish engulfer will be your reason to enter. If we have a fall without any reason to enter 50 EMA, we have a bullish engulfer, that is your entry. If we have no entry here, no entry here, no entry here, and then the price just fall, hit the zone here, in that case, I look for my entries at this area like bullish engulfers and double bottom entry conditions. These are the conditions I'm looking at for buy and sell from here. Once we have a condition, we are good to go long. Conditions are very important. Without conditions, there is no point of trading, and without that, we are just gambling. We always observe the market, looking at the trend. We have observation, then we look for the condition. Once we have a condition, we look for the entries. Once we have the entries, yes, we set the stops and target, and that is how we need to have these rules in our trading arsenal to become a successful traders. Discipline is very important in your trading. Without discipline, you cannot make it in any industry or in any field you want to become successful into. I hope you got a value out of that, and I hope you have learned something out of it. If yes, do not forget to hit the like button for me. It helps me in a YouTube algorithm. If you're new, subscribe so that we can all trade together, trade efficiently, so that you won't miss daily updates and weekends educational video like this every other week. Hope you trade green rest of the week. See you guys in the next video. Have an awesome weekend. Take care.